Good morning and welcome to another week of trading. It is, of course, President's Day in the US, which means we are essentially waiting for tomorrow and the restart of US activity. The week begins on a quiet note. And also, not only that, but we've got a holiday in China. They are off all week for the New Year holiday. So it has been a bit of a mixed start to trading across the globe, really. A fairly subdued session across markets overall, really. If we look at what we've actually got in early trading this morning, despite the slight quieter trading, you've got the Hang Seng futures were doing very well overnight. They are up over 1%. The Nikkei also holding its ground, slightly lower from where we were. We were up at 58,000 just about a week ago, but that's continuing to give back some of these gains, as you might expect, that we saw in the wake of the election. But let's look at what's going on in the FTSE 100 this morning, because we have just, of course, opened after 8 o'clock this morning. I just got to continue the theme. There is almost nothing of note in terms of RNSs this morning. So if anyone suggests that I've been given the poor slot to start the week, you'd be right, because there's nothing going on this morning. The top riser so far this morning, Sage Group clawing its way back higher after an absolute pasting over the past month or so. A month ago, we were trading above £11 a share. We're now trading just about above £8 a share because of the AI fears that have driven everything lower in so many sectors over the past month or so. NatWest moving high in early trading, though, so continuing to recover some of those losses it suffered in the wake of that really kind of unpleasant fallout off the back of its acquisition of Evelyn Partners and the results last week, which I think is what you'd expect to see in this kind of uptrend. It's been so very, very strong over the past year or more. In fact, if we go to a monthly chart, you can see, ignoring, of course, 2008, if we go to the sane end from 2020, NatWest has been a very, very good investment from the post-COVID lows, had you but known it. Very solid performance, just that sustained weakness for most of 2023, which was interesting because the broader market, of course, that was when the Mag 7 were at their height, really, or certainly beginning to take off. But then since then, the share price has not looked back, and this is the weakest month for NatWest since October of 2023, but a very, very strong performance. It's not often that you see a high street bank in the UK essentially triple in value over the course of about 2.5 years, but that is exactly what NatWest has done. So it's not really surprising to see the pullback you've had in that this morning. Let's just check on what we've got in terms of the movers. Try and get my list back in the order. Standard Chartered also 2% higher after a little bit of dropping last year. Of course, if you remember, the CFO announced he was leaving. The reaction was so dramatic, mainly because he was seen as a potential successor to the current CEO. Now they have to go and find somebody else. But that doesn't really interrupt the longer term fundamentals of the business, which, as you can see, another great investment, another excellent trend that you should be sticking with. These things always look easy with hindsight, but you can see how the prices remained resolutely above the 50-day moving average, with a brief blip in October that proved to be the buying opportunity for the next leg higher. Let's look at this kind of macro picture that we have across the board. We'll start with the FTSE 100, not at a record high this morning for a change, just for a brief period of interruption. We did see a record high last Thursday above 10,800, but still holding up very, very well. With the morning of so little news, it's not surprising the index is struggling for direction a little bit, but overall, I think we're seeing an index that looks very well positioned for further gains. Of course, it only trades at 15 times earnings, so that's a suggestion that maybe we'll see further gains from here, if only because it's not as expensive as its US counterpart. So when markets go through their periods of panic about US stocks being expensive, the FTSE 100 is one of those places to go. And of course, it's finally coming into its own because of the number of mining stocks in the index. And we are increasingly seeing this commentary that we are seeing poised to enter, shall we say, much better age for mining stocks. They've been out of favour for so long, pale in comparison with the performance you're seeing in tech stocks, the growth you were seeing in earnings. But now, if the world's demand for metals and minerals is about to step up a gear or several gears, I think you should see miners do very well out of that. And with the FTSE 100 kind of hosting such a large contingent of them, a very big weight to the index overall, the mining sector, it is the place to be. So maybe in a few years we'll be talking about the FTSE 100 as being the expensive index and the S&P 500 as the cheap one. Anything can happen. But so we're holding above 10,461 in early trading this morning. US futures open, of course. US markets, the cash open, of course, doesn't happen this afternoon because it is a US holiday. But it's been a very interesting market. Interesting in the sense of it hasn't really made any progress. So the S&P finds itself roughly 68.55, which is where it was in early December. And in one sense, the market has gone nowhere. The situation is even worse for NASDAQ. We'll come to that in a second. We've gone sideways since the beginning of December. We have seen, of course, record highs in that time, but they've not been sustained. But you have seen equally dip buyers coming in around 67.30, which is, again, what you're expected to see. You have strong periods, this rebound post-tariff crisis in April, continued, and then we've really moved into this trading range, this sideways movement where there's no real indication of where we go from here, but a very solid performance for the index over the past 6 months. It's the weakest start for US stocks versus the rest of the world since about 1995. So as we're looking at record highs for the FTSE 100, we're looking, of course, record highs for Nikkei. We saw one for the DAX in early January, though we've struggled a bit since then. It is because you're seeing this flow out of the US. It's not so much a sell everything connected to the US and the Greenland, of course, if you cast your mind back a month ago when we were doing a panic about Greenland, seemed to provoke another round of visit time to sell US stocks. It's simply, I think, you're just seeing rotation away from it in the shorter term. We'll see whether it reverses, but a very poor start relative to the rest of the world for US stocks for the start of the year. Looking at the DAX, this as well picking up. European markets having a very strong run of late, certainly picking up nicely from where we were in early February, about 700 points lower. It looks like you've had this consolidation. This is exactly what you get as well. Pullback, it doesn't always immediately resolve into a bounce. Sometimes it takes its time, and that's exactly what you've got here from about the 20th of January. It's taken us about 3 weeks for that to resolve itself in favour of this next move higher up to 25,400. So we could well see fresh record highs in that index this morning. Not much news on the continent either, really, to keep an eye on. Oil prices as well, we'll just run through the macro stuff, as there's not much else to talk about, really. You've got, of course, oil prices, watching what goes on in the Middle East. More talks with the US and Iran are scheduled for, I think, Tuesday. Some comments from both sides over the weekend that they were hopeful of moving forward some kind of progress, at least sort of talking about making progress rather than actually making progress. But I suppose talking about it is better than nothing. Iran saying that maybe it might be prepared to discuss some of its ballistic missile programs if the US would talk about sanctions. So there are perhaps grounds for hope. Mood music out of Washington continues to be that perhaps whilst they are preparing for some kind of action, there doesn't seem to be the desire to carry it through this morning, really, despite the Israeli Prime Minister meeting with President Trump last week in Washington. So that's left oil prices a bit becalmed, really. US crude hovering around 62, 63. This leg higher, surge higher, really, from January, $56 a barrel, where we found a low just as we did in mid-December. That seems to have run out of steam for the time being. I'm just looking a little bit tired, but we did see, of course, higher highs in this uptrend. The big question is, we've talked about this endlessly. Does this just go the way of all the other bounces in oil that we've seen, at least over the last year, if not even further back in time, i.e. eventually it resolves itself into another move low? Because you can see, looking at that context from where we were, even at the beginning of 2025 at $70 a barrel, to go from that to $55 a barrel by year end. This is just a short-term bounce within that longer-term downtrend. So there's not much to really drive the price at the moment, absent geopolitical concerns. And those, I suppose, thankfully, from one perspective, unless you're trading, unless you're long oil, those don't appear to be igniting. So that's just leaving oil looking a little bit becalmed in trading. And everyone's other favourite asset this morning, gold prices, there we go. Looking a little bit better than it was earlier this morning. You had about 1% loss for gold overnight. Silver prices under pressure as well, but holding up. We did have that brief outbreak of volatility on Thursday when we dropped back below 5,000, but we're still holding that $5,000 level in early trading today. So that's a hope that maybe again we've got a chance to resume our ascent in gold prices. It has been volatile. It would expect to be volatile after the movements you've had since those ridiculous record highs. I think it's the only way to talk about it at the end of January, when the frenzy in gold and silver, that's probably the closest thing I've seen to a bubble in a long time, really. Certainly outside of cryptocurrencies, but gold doing its best to sort of continue its move higher after this, really the shaking out, if you can shake out froth, if I'm not mixing my metaphors, shake off the froth from that market that you had right at the top here, to go from the peak of euphoria to the depths of despair within about 48 hours seem to be the way for gold prices, and even more so for silver, which of course, as you can see, it wasn't such a great week last week for silver. Really, Thursday put a dent in the bounce, but the selling seems to have stopped around 74. So we'll see whether we can just hold on to these lows. And then to go from actual gold, we go to digital gold, Bitcoin. It wasn't a great week, but it ended on a slightly better note into Valentine's Day. We got back to $70,000. It's just notable how it just can't hold on to these gains, and it's slipping lower. And I think this is increasingly the story of Bitcoin. It's not about the sudden dramatic moves to downside that catch everybody's attention. It's merely that you check on it every other day and it's a little bit lower than it was. It just continues to drift and drift and drift. That's exactly what we've got so far in early trading. You might argue, I suppose, perhaps less so with cryptocurrencies, but with the US out of the picture today for President's Day, the volume's not there. Ether a little bit better this morning at $19, but just not really, I'm unfair there, just below $2,000, trying to wipe out the price. Holding up okay, but still firmly within this broader downtrend. And as with all other markets, if you get this kind of sudden lurch to the downside, you will then end up with some sideways trading until the next direction really establishes itself. But of course, the main direction of travel at the moment appears to be lower, even if we haven't tested these lows from the beginning of February. We should look briefly at what's coming up for the week ahead as well. It is, of course, mid-February, now the 16th of February. So notably, of course, as I said to be at the beginning, Chinese markets out of the picture all week for their New Year holiday. US markets closed today for President's Day, or Washington's birthday if you prefer. It's a week of UK data though. If you're trading the pound, if you're trading sterling, if you're FTSE 250, keep an eye on this. UK employment data on Tuesday. Unemployment rate expected to hold at 5.1%, and earnings, the growth in earnings is expected to slow as well, so watch out for that, for the focus on what the BOE does next. The second part of the trio, inflation, 7 a.m. Wednesday morning. We're expected to see a slowdown in headline inflation, core CPI also slowing down, which the Bank will be delighted to see, really, although still well above the target. 3%. And then also Friday is your third piece of the puzzle for UK data, retail sales. Other things to watch out for this week, durable goods on Wednesday. Friday is flash PMI day, so it provides an insight into where the global economy is heading. And then on to the earnings front, empty day today, as you'd expect. Not so much in the way of really heavyweight stuff in the US for the time being. We are in that odd gap between the 6 of the Mag 7 that have reported, and Nvidia, which likes to stand out by itself and come later on in earnings season. But you do have Walmart, perhaps one to watch out for getting a sense of US consumers. Walmart, of course, recently entered the $1 trillion market cap club, so it's still doing very, very well. Very solid investment over the last few years, Walmart. But it's busier in the UK, and again, miners taking precedence here, so watch out for those if you are looking at the sector. Anglo American on Friday, before that Rio Tinto on Thursday, Glencore on Wednesday. So there's two, I don't quite know how to describe them, lovers that have fallen out, Glencore and Rio Tinto, although it's still a possibility of a merger. They're not so much jilted as they seem to have fallen out because they can't agree the details, but they are next to each other. Perhaps they didn't report on the same day. And then also defence back in focus, Antofagasta as well Tuesday, and then BAE Systems on Wednesday. Of course, a much bigger part of the FTSE 100 than it used to be, thanks to the huge surge in defence stocks over the past 2 years, and more likely to come. We had the Prime Minister over the weekend and saying they're thinking about increasing defence spending. That seems to be the limit of UK policy making at the moment, to think about something rather than actually do it, but talking about increasing defence spending, so watch out for this. And I will just flag, we don't often flag the ex-dividends, but I will do this week because if you can see that there, if I can zoom in so you can see a bit bigger. Nope, I can't. There we go. Let's try and do it the old-fashioned way. Where are we? There we go. It is a whopper for dividends on the FTSE 100. It's about 30 points, I think, from memory, off the index to be applied on overnight Wednesday, Thursday. Imperial Brands, big dividend payer. EasyJet, Games Workshop, not so much for dividend payer, but GSK, which they've helpfully put in abbreviation for you there. It's actually shouldn't even be GlaxoSmithKline. It's GSK, Shell, BP, Barclays, AstraZeneca, all those last named very, very big dividend payers. So they are the ones to watch out for, and a few on the FTSE 250 as well. So it is going to be a busier week. You have to twiddle your thumbs today. The US markets close, so you will feel the lack of action in markets this afternoon. Pity those of us who have to write the afternoon market update and think of something to say on a day where nothing essentially will happen. But it is promised to be a busier week with the focus remaining squarely on how we see the US economy evolving, also the UK data, keeping an eye for what's coming up later in the year. Thank you very much and have a good day.